for every 10% that you put into bonds, you are going to reduce your return by about 0.5% per year for whatever period of time you're sitting on those bonds. And so I really discourage young people from having any bonds in their portfolio and to hope that the market goes down for the first 10 years of their investing experience. But of course, Rick is right, and the whole industry is really concerned about people having the ability, this is what John Bogle said, the ability to stay the course. He felt that was the number one thing you needed to be able to do to be a long-term success.
You look around your office, and I can guarantee you 80% of the stuff that we're sitting on and looking at wasn't made in the United States. It was made by companies outside the U.S. So why are we not investing in those companies? I think what's going on here is a lot of recency bias. Oh, U.S. stocks outperform, so let's go back and come up with all the reasons why they outperform and extrapolate that into the future. Well, that's wrong. You don't want to do that. You want to say, look, these are viable companies overseas, in Europe, in the Far East, in Australia. Well, let's go ahead and take a bite of that apple too. If you go down this path of putting small cap value in your portfolio, you have to, number one, understand it thoroughly, what you're getting into. Number two, know that you're going to be paying more money. The cost of these funds is higher than just buying a S&P 500 fund or a total stock market fund. It costs 0.03% to buy a total stock market fund. It might cost 0.3% to buy a small value index fund, but it is 10 times higher. So the cost will always be higher. And the last thing is, it may not work. You may not get a premium. Nobody's guaranteeing a premium.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello and welcome back to Catching Up to FI. I'm Bill Yount, one of your co-hosts, and I'm with my beautiful esteemed co-host, Jackie Cummins-Koski. We are honored today to have two titans of the financial literacy movement, and we'll introduce them in a second, but we want to talk about first the charities that they both have picked to support. And maybe we'll let them also tell us a little bit about them in a minute. But Jackie, where are those here? Paul wants to support the Merriman Financial Education Foundation at Western Washington University. And you can find that at www.paulmerriman.com. And Jackie, or Paul first, tell us a little bit about that because it's unique. And we want this to be a model for other universities.
Well, what's exciting about this program, my wife and I started 10 years ago or more supporting a class on personal investing for non-finance majors at Western. But it was obvious that there were a whole bunch of young people who were not getting the message. And so we have worked with them for years to create a program that every student coming through Western, about 15,000 of them, will be required to take about 30 to 40 hours of financial literacy. And I think it will be truly life-changing for these young people.
Oh, that's awesome. And then that should be a model for all universities, quite honestly. And I hope you market that across the nation because I wish I went to that university and maybe I'll encourage my grandchildren to go to Western Washington University, should I ever have any of those. And then Rick Ferri is also with us today, and he is a Bogle head through and through. Yeah. And he wants to support the John C. Bogle Center for Financial Literacy. Rick, can you tell us a little bit about that?
Well, as you know, John Bogle was the grandfather of the first index mutual fund and the founder of the Vanguard Group, which is a mutual benefit company, for the lack of a better way of describing it, where it's a nonprofit investment firm. Anyway, over the years, Jack Bogle had been instrumental in helping people manage their own portfolios, increasing the number of index funds that are available to people through Vanguard, and has really changed the whole investment landscape for all of us and saved all of us as a group billions upon billions of dollars in fees that are normally charged by Wall Street and actively managed funds and so forth. So the Bogle Heads was created starting in the late 1990s to help people who want to become do-it-yourself investors. And in 2012, a group of us created the John C. Bogle Center for Financial Literacy under Jack's oversight to fund this nonprofit organization to create the content, the conferences, podcasts, online website, bogleheads.org, and everything to help people be able to manage their own money and to go forward, make a better world for people, and save them a lot of money. So that's at theboglecenter.net is the website for the Bogle Center. And every year we put on a conference, and this year we're putting it on in San Antonio, Texas in October. So hopefully we'll see everyone there.
Be there this year, but Jackie's speaking at it, and we've been to the last two, and we wholeheartedly recommend this conference. It's actually migrating towards a younger crowd. There's not so many people with white hair there anymore. There's the FIRE community and younger folks, and they're embracing that. So we encourage our audience to join you there and help grow the conference.
Yeah, and Rick mentioned that he is in Texas, and this is a great thing to see on YouTube, but you've got this cool artwork behind you. It's an actual pair of boots. So I'm like, gee, you must be from Texas. You're like, yeah.
No, my wife is from Texas. There's a saying, if your wife is from Texas, eventually you'll be from Texas.
That's right. Tell us about that artwork behind you. It's just so cool looking. Yeah, they're a real pair of boots, but they're on the wall.
Yeah, well, we were in Fredericksburg, which is a German community where Nimitz was born, actually, a pretty famous German community here in Texas. Beautiful area, great wine region, by the way, if you like wines. But we were walking through an art shop, and they had boots like this. A local artist had painted them, and they're actual boots. So they're cowboy boots that they get from the rodeos, from the cowboys who sort of discard their boots. This artist picks up these boots and she paints them. And this particular pair of boots belonged to a bull rider. He was thrown off the bull and he messed up the heel of the boot and just discarded them. And she asked if she could have those boots. And she then painted a picture of the boots. And we bought the picture from her. So it's a pretty interesting piece of artwork, Texas art, if you will.
Well, we encourage everybody to go to the YouTube on this one because both Paul and Rick got haircuts and put on makeup for this. So they're
I did not put on any makeup. Maybe Paul did. I did not.
He's joking about the makeup. But they do look great, I have to say.
They look pretty good. All right. They don't need an introduction, but we better do one anyway for our listeners, the few listeners in the world that haven't heard about Rick Ferri and Paul Merriman. Jackie, would you please do me the honor of introducing Paul?
Yeah, this is Paul's second appearance on Catching Up to Fi. Go back to episode 8 and 9, and you can hear us talk about his book, We're Talking Millions. Actually, that's when Becky was co-hosting the show, so you'll get to hear her on there, but definitely worth going back to. He is a nationally recognized and award-winning authority on mutual funds, index investing, and asset allocation. Among his many professional lives, he has been a stockbroker on Wall Street and a wealth manager at Merriman Wealth Management, which was founded in 1983. I don't even know if I was in high school.
I didn't even think you were born back then.
Oh, see, there's a guy that knows how to give a compliment.
Rick is calling me old, and Jackie is timeless.
He is. You can see, yeah, if you want to see me blush, if you want to see a black girl turn red, then watch it.
But Jackie retired at 49, so you figure it out. I'm not yet retired, but one of our guests is in his 80s and he's as vital as ever. You can't tell the difference between Rick Ferri and Paul Merriman. They are both timeless, but Paul Merriman travels the world. He is so active and involved in this financial literacy movement. I hope I'm as vital as he is when I'm his age.
The difference is I will need a nap after this get together. Will not.
Well, the funny thing is you allegedly retired in 2012, but it seems like you are busier than ever. So just to finish up a little bit more about Paul, he created the Merriman Financial Education Foundation that is dedicated to providing investors of all ages with free information and tools to make informed decisions in their own best interest and successfully implement their own retirement savings program. You know, I love that. I'm a huge financial literacy buff. He is the author of 8 books, a columnist for Market Watch, and produces the podcast Sound Investing. At his website, paulmerriman.com, he provides an abundance of evidence-based free books and resources. So make sure you check that out, and I will drop that in the show notes.
He also is a tables guy. And if you want tables upon tables upon tables, you go to his website, and he has evidence for everything. And we're going to talk about small cap value today, because if Bill Bengen is known as Mr. 4%, Paul Merriman should be known as Mr. Small Cap Value.
Oh,
That's true.
Let me introduce Rick before we dive into our topics today. You know, Rick Ferri, this is his first time on the show. He's a CFA, chartered financial analyst, and prominent figure in the world of personal finance. He's a former military pilot, so thank you for your service, accomplished author, financial advisor, and speaker known for his expertise in low-cost investing strategies and index funds. Rick is recognized for a straightforward approach to investing, advocating for simplicity, diversification, and long-term thinking. I mean, he has a new endeavor, which we should ask him to talk about, too, in just a minute. Through his books, articles, and speaking engagements, he has helped countless individuals understand and implement sound investing principles. There it is, sound investing again, to achieve their financial goals. Ferri's insights are highly regarded with his investment community, making him a trusted source for wisdom for both novice, that's maybe our audience, and seasoned investors alike. He is the host of the popular podcast, Bogle Heads on Investing, and author of the popular book, All About Asset Allocation, one of his many books. But what he wants us to know is that he's an accomplished pickleball player. He lives in an over 55 community, and, you know, they must have pickleball out the wazoo.
They do.
These two guys have different philosophies, but there is one important area they agree on, and that is deep passion for financial literacy and investor education. Paul, welcome to have you back here. And Rick, welcome to the show for the first time.
Thank you.
great to be here.
All right, Jackie, we want to start. This is all about asset allocation, factor investing, and sort of a little bit of a how-to, but also looking at the breadth of choices in simple, less complex portfolios. So we've talked with Bill Bengen about the 4% rule, now soon to be the 4.7% rule, when his new book comes out with his new research. So he's going to have to change his license plate from Mr. 4% to Mr. 4.7%. There are rules of thumb, but are there Goldilocks portfolios, allocations for asset allocation in early, mid, and late accumulation? And then are there good asset allocations for early and late decumulation? The phases of life, the seasons of investing, I'm kind of interested in. People talk about find something, stick with it for life, but it would seem to me that there's glide paths of sticking with it for life that occur. So what do you recommend for early asset accumulate?
So the question that we're talking about here is asset allocation, which would be how you allocate your money between a cash component for your emergency fund, or some people call it a reserve, how much you should put in fixed income for stability, and how much you should put into equity for growth. So that's really the question we're asking. And what you're asking is, for a younger person or somebody who is just getting started with accumulating for retirement, how would you allocate? And first off, I want to talk about asset allocation in general, where whatever you decide, whatever you choose to use, it has to be within your ability to handle that risk. So if you decide to be very aggressive and have mostly stock, you have to be able to stay the course through the entire period in which you're holding a lot of stock. So if you decide you're going to be in equity for 20 years, you have to hold that equity for 20 years, because if you jump horses or change horses in midstream because the market went down, then you probably had the wrong allocation in equity to begin with. You had too much risk. So whatever it is that you choose, growth, where you're going to have more volatility there, more risk on a year-over-year basis, you need to be able to stay the course. Now, with that being said, in general, since you do have more time when you're young, you should probably have, if you can handle the risk, more equity in your portfolio than fixed income. You're going to have a cash component, which is on the side for your emergency needs and liquidity and things that are coming up in the next few years. But after that, you're really looking long term. So you want to get the long-term growth of equity over fixed income. And what is that? Well, the experts are telling us that in the very long term, you should get about a 4% equity risk premium over bonds. So if bonds are yielding 4%, you should be looking to get a long-term return of about 8% on your equity. But it's a much more volatile ride. So now the question is, first, how much equity can you handle? And then when you're young, you should probably go to the top of that level and make sure that you stick with it. So that's my answer, Bill.
Okay, Paul, what do you think about sort of early, and we'll move to sort of mid and late accumulators?
Well, for the early, I think the important thing to understand, I mean, Rick is right. We all need to identify our risk limits and make sure we stay within them. But it's important for a young first-time investor to realize that for every 10% that you put into bonds, you are going to reduce your return by about 0.5% per year for whatever period of time you're sitting on those bonds. And so I really discourage young people from having any bonds in their portfolio and to hope that the market goes down for the first 10 years of their investing experience. But of course, Rick is right, and the whole industry is really concerned about people having the ability, this is what John Bogle said, the ability to stay the course. He felt that was the number one thing you needed to be able to do to be a long-term success. So I'm for as much equity as you can possibly stand when you are young. And of course, we have to then ask what that equity looks like. And Rick and I might have some differences of opinion, but I do think it's probably some combination of, to keep it very simple, some combination of an S&P 500, maybe total market fund, and a small cap value fund. It could be very little small cap value. It could be half small cap value, again, depending upon how much you understand the reason to do that and the risk that is inherent in making that decision.
So, Paul, I have a question for you talking about simplicity and trying to make this look simple. So, obviously, the work that you do with your foundation and that you want to try to help everyone understand, regardless of their age, what things do you do to help people understand what sometimes can be kind of complex when you talk about small cap value and things like that? How do you approach your students to make trying to construct a portfolio like this a little more simple?
Well, remember that the goal is to help the do-it-yourself investor. And I believe if you're going to be a successful do-it-yourself investor, you actually need to have a lot of the knowledge that a good investment advisor would have, because in essence, you are the investment advisor for the most important investor in the world. And so I really encourage people to be able to dig beyond the most simple level. I believe that we should understand, and we have tons of tables to help you understand, what is the risk that you take if you have a portfolio that is half in equities or 70% in equities or all in equities. And not only what is the real risk that you're likely to be exposed to, but what is that premium that you're likely to receive over the long term? Because we are really trying to help young people, to start with, learn how to build a business. I think the investments that these young people make should not be viewed as some sort of a passive thing that's going on. No, they are investing in businesses that they own part of, that the people who are in those businesses, that they still have a job, are going to work and working hard and helping you build your financial future. You are a business owner when you have a portfolio. And we want people to understand that, which then gets you into diversification. Do you want to own one business or do you want to own 1,000? Well, Rick and I would both, I think, agree. We want to own many businesses in our business.
So, Rick, what do you think? Trying to simplify some of this for the average person.
Well, I think we're going to get into how Paul and I differ in how we would do the investments. So let's say that you're a young investor and you decide to be 100% of your long-term capital, long-term investment portfolio in equity. What should you do? Well, you have to decide whether or not you think you're smart enough to beat the stock market or not. Or you think you're smart enough to pick people who can beat the stock market or not. That's the first thing you have to decide. Or you say, look, the return of the stock market is just fine. It's been doing fine for well over 100 years. And I'm just going to accept the return of the stock market, and I'm going to try to do it with the least amount of fees and the least amount of taxes, because fees and taxes are corrosive when it comes to getting a return from stock. And if you're okay with getting the return of the stock market, which is better than 95% of what people get who try to beat the market over the long term. I mean, there's a few who outperform, but you can't tell whether they're lucky or skillful. Everybody points to Warren Buffett, but when I ask them, do you own Berkshire Hathaway in your portfolio? The 95% of the people who say Warren Buffett is a good investor and has outperformed the market, and I ask them, do you own Berkshire Hathaway in your portfolio? Almost all of them say no. Well, why not? You just told me that he's a great investor. It really gets to be very weird when you start asking people who think they can outperform the market why they think they can outperform the market. They don't have any more information than anybody else. It's really a fallacy that's perpetrated by the media and by Wall Street, because that's how they make money. They make money through trading. So me, a long time ago, 25 years ago, if not more than that now, almost 30 years ago, I started following Jack Bogle. He said, you're not going to be able to do this. You're not going to be able to outperform the market. So just be the market. Become the market. Buy an index fund that tracks the whole market, and you'll outperform almost everybody else. And you know what? He's absolutely right. That's true, not only for the U.S. market, but for the international market as well. So really the question on how to set up your portfolio on the equities is how much should you have in the U.S. stock market and how much should you have in the international stock market? And a lot of the work that I've done shows that it's about 2/3 of your money should be in a U.S. stock market index fund that tracks the U.S. stock market, the total stock market, all 3,700 stocks. And then you should have maybe the other 1/3 in an international portfolio that tracks the international stock market, which would include emerging markets. And that is all you need. You don't need anything else. You just need that. And anything else after that is just speculating on something. And you don't need to speculate. Let the markets just do what they're going to do, and you're going to outperform almost everybody else.
Well, interestingly, people say that you don't need international equities, and we need to get into international a little bit. And I find it interesting that you would put in a third. I think the market is about currently 65% US and 35% international, if I'm not correct. And that is correct. Increased recently. So you recommend sort of buying the world market is kind of what you're saying. But international equities have not performed for like 15 years and have provided a big drag on the portfolio. And, there's a way to tilt too. As American investors, people say, if I invest in all US, I've got international exposure because of the company's revenues. But you don't recommend that, right? And Paul, take that first.
Well, according to what I learned from Dimensional Funds in 1994 when I went through their training, what I was taught by those folks, and it's an organization that their work is academically based, I was told that when you add internationals, that you are not expecting to increase the return of your portfolio. What you are doing is you are diversifying, which whether it's because of currency differences or just different economic scenarios, you're diversifying amongst more large cap blend companies. I believe, and I learned this from the people at DFA as well, I believe that if I'm going to add something, I want to add something that has a history, one of actually being different, and more than just a diversifier, but that will add the potential to get a better rate of return. And so I would prefer, if I had a young investor with me, that I would rather have them they might put a major part, they might put 90% in the S&P 500, but the studies show if you put 10% in small cap value, you have the potential of an extra 0.4% a year return looking backwards. Now, if you put 20% in, you get a little more. But if I'm going to diversify or recommend young people diversify, I want them to diversify in a way they get additional equity asset classes for diversification, but also equity asset classes that are built to make more. And so while it may sound complex, it isn't complex. It means you have two funds to put in your equity portion of your portfolio instead of one.
Well, Big Earn is not a fan of international stocks, and nor is Frank Vasquez, two of our friends. Frank Vasquez says that, he can take a look at currency trends and tell you the performance of international stocks. So he feels that currencies dictate that performance, and we won't see better performance of the internationals until the value of the dollar drops, which it has not historically. Do you think currency is a diversification or a speculation? And do you agree with Frank's tenets?
Well, I'm not familiar with what his opinion is about international stocks. If you look at, say, the Vanguard World Equity Fund, which covers the entire world, you have about 3,500 stocks that are U.S. and 6,500 that are international. So we're talking about a lot of companies here from around the world and a lot of different currencies. And it's true that if the dollar is strong, that the U.S. stock market has a higher probability of outperforming just because of the exchange rate. And that has been the case for the last 15 years since the financial crisis. Not the case this year. It's not the case in 2025, and we begin to see international stocks outperform by a couple of percent right now. We don't know if that's going to continue or not, but I don't want to take that risk of trying to guess which way currencies are going to go, or guess whether the U.S. stock market is going to continue to outperform the international market, which, by the way, the international stocks have not been bad over that 15-year period. What has happened is the U.S. stock market has been so good. So you've got this overshadowing, okay? I mean, if you just invested in international stocks, you didn't do that badly over the last 15 years. You did almost about what you would expect to get. An equity risk premium, say, of 3 or 4% over fixed income. That's what the international market did. That's normal. That's what you would have expected 15 years ago. But it's the U.S. market that did so well because of large tech. Now, what goes around comes around. The expected return going forward from today for U.S. stocks and international stocks is the same. It's about 4% over a 10-year treasury. Call it 8% expected return. That has never changed. I mean, there's no reason why international stocks would underperform U.S. stocks. They're equities. You look around your office, and I can guarantee you 80% of the stuff that we're sitting on and looking at wasn't made in the United States. It was made by companies outside the U.S. So why are we not investing in those companies? I think what's going on here is a lot of recency bias. Oh, U.S. stocks outperform, so let's go back and come up with all the reasons why they outperform and extrapolate that into the future. Well, that's wrong. You don't want to do that. You want to say, well, look, these are viable companies overseas, in Europe, in the Far East, in Australia. Well, let's go ahead and take a bite of that apple, too. I'm not saying you put all your money there, but 2/3 in U.S., like you say, 65%, a market weight in U.S., and then a market weight of 35% in international. Certainly makes a lot of sense from diversifying stocks because you get now 3 times the number of stocks in your portfolio. It certainly does diversify your industry groups because you're not getting this magnificent 7 tech stocks that you're getting here in the U.S. You're getting a lot of industrials and materials and financials, and it's not a lot of high tech. It's more like what the S&P looked like 50 years ago with chemicals and so forth. That's what you're getting when you invest international. And you're getting currency diversification against the U.S. dollar, which, yes, in the last few years, it's been very good for 15 years. But it's not always going to be good. So all it is diversification. That's all it is. I want to diversify that risky portion of my portfolio as best I can. And having 1/3 international and 2/3 U.S. does it over the very long term. Now, granted, there's periods of time when U.S. does well, and there's periods of time where international do well. But we tend to have a recency bias, just focusing on what just did well in the past, extrapolating it into the future. And that's where we come up with a lot of people who now say, because they have to say things in the media, oh, we should just have a U.S. portfolio and forget about international. So I'm not for that. Now, do you want me to get into the small value thing, or do you want me to stop there?
Well, let's hold off on the small value for just a little bit. I want to hear Paul's take. I think I'm aware that he has 50% U.S. growth and 50% international, so he tilts probably a little more towards international. And why do you do that, Paul?
Well, again, what I learned from DFA back in 1994 was they made the case for 10 different equity asset classes. And so what I have in my portfolio in the equity portion is 10% each in those 10 equity asset classes. And I have an expectation that at some point they will all perform well. At least that is the belief of the academic community. Now, having said that, I think the older I get, the better I feel about having a massive amount of diversification. But the reality is, and this was a turning point in our educational work, was when we were able to go from a 10-fund strategy and 10 equity asset classes down to 2 or 3 or 4 and perform with the same long-term, approximately the same return. So we've been working to make it simple. But for me, I love it being spread amongst all of those. I don't even know what return I got last year. It doesn't matter what return I got last year. We take out 5% of our investments the first of each year. That's what we have to spend. And we believe with all of those different equity asset classes, about half of our portfolio, that will be treated fairly over a long period of time, regardless of whether it's U.S. or international. And we've got to be careful about looking backwards always, whether it's about small cap or international, and saying, here's how it's done over the long term. What a lot of people fail to realize is the great performance back in the 70s of the international market was because of Japan. And Japan's prices went through the roof. I mean, I think at the peak, their PE ratio was about twice that of what the peak was of the boom, the technology boom back in the late 90s. And what is the likelihood of that happening again in the Japanese market or some other market? I don't know. I'll be there when it happens as long as I'm alive, but I can't know, but I'm okay with not knowing. And that's where Rick and I totally agree, I think. Broad diversification really takes the responsibility of trying to be on top of things and do the right thing now. It takes that whole consideration out of your life as a either do-it-yourself investor or hiring others to do it for you.
Yeah, like sticking with your plan. So, Paul, a few times you mentioned DFA. Can you tell us what DFA is? Are they another fund company?
They are a fund company, and they build index-like portfolios. At the point that I was introduced to DFA, they were the only one like this. Today we have Avantis, which is a similarly run organization because the people at Avantis came from DFA. And so DFA believed, and a lot of the work was from Dr. Fama and Dr. French, that there are these factors, which is what Rick and I talked about before, the factor, investing, the big, the small, the value, the growth, the U.S. international, all of these different things that impact the value of our portfolio. And they have a history. As a matter of fact, they have a small cap value portfolio that's been managed since 1993. That's a long time to have a small cap value portfolio, and it has way outproduced the S&P 500 since 1993. So they are believers in this factor investing process, and their expertise has been on how to build the portfolio to capture those factor premiums.
Gotcha. So we will get into the small cap value, but I'm so curious, you guys. This is debated a lot amongst other people, amongst our community, but target date retirement funds, is that enough? Because they're attempting to put together these portfolios, right? And normally, if you're working for a company or an organization, if they default you into a fund, it's likely to be one of these target date funds. So Rick, I'm going to start with you. What do you think about target date retirement funds?
Well, as you say, the concept is it's already a balanced portfolio. So it already has U.S. stocks, it has international stocks, it has a bond component to it, and it's done for you. It's managed by the mutual fund company for you. You don't have to do anything, so you get instant diversification. All you have to do is pick the date or the year that you technically, but the word is, well, if you're going to retire in 40 years or 30 years, you should pick a 2055 fund because that's 30 years out. Okay, or you could do it another way. You could look under the hood and you could say, well, what's the asset allocation of the fund between stocks and bonds? And, what asset allocation do I want? And then you pick a fund based on that rather than the year. Okay, now there's two types of target date funds. There are actively managed funds and there are target date index funds. And the actively managed funds, they're moving things around, trying to outperform the markets. As I said before, active management. They're charging a fee of maybe 0.5%, maybe 0.6%, versus the index, the target date index funds, which are just a composite of various index funds, a U.S. stock index fund, international index fund, a bond fund, extremely low cost fee, maybe 0.1 or less, 0.08%. A few companies have these. A lot of 401k funds have these. I really like target date index funds for people who are putting money away in a retirement account like a 401k, 403b, or SEP IRA. I think they're great. You just have to decide what asset allocation you want, find the fund that has that allocation, put your money there, and leave it alone.
There you go.
So, Paul, you are a bit of a fan of this too, but there are some downsides to target date funds, and maybe you could talk to what are the downsides. I think you have about 10 of them.
Well, target date funds have got to be built for the average investor. And that's a big deal because they are trying to figure out how do we manage these portfolios so that we keep all of our investors on board, staying the course for the long term. And so what you're going to find is they're generally very conservative. As a matter of fact, in the Vanguard, and I think they have great target date funds, but in the Vanguard fund, they have 10% in fixed income, which means that in their 20s and their 30s, they are going to be making 0.5% more than likely. We can't know, but at least the probabilities are they'll make 0.5% less per year for 20 years. And when I met with John Bogle back in 2017, this was one of the things I wanted to understand why they had that 10% in bonds. And what he said is that the investors, because they're trying to keep it real simple, the investors need to understand we are going to, over time, going to build a portfolio that's going to have stocks and bonds. In the beginning, you're going to be almost all in stocks. But the bonds are there, and we will know when to change that. Now, does he understand that it costs 0.5% a year? Yes, he does. But they believe that keeping it simple and showing people how it works, and then they get to be part of the program, and they are going to be more or less like the market, even though they've got 10% in fixed income. That is part of the stay the course goal that they're trying to build. I say, why not educate people to understand that any bonds in that portfolio. It's not going to protect you from a bear market. You are not going to be able to brag how well you did in a bad bear market because you had 10% in bonds. Just doesn't work that way. It's still going to be awful. And so my goal is for young people, I want all the money going into that thing that's down and dirty during a bear market, because those things as a group are going to come back. At least they have in the past. And we want to maximize the opportunity through the dollar cost averaging. The other major thing is it's all basically large cap blend equity. So we have a free book, 2 funds for life. One fund is the target date fund. The other fund is, strangely enough, small cap value, and you build the portfolio with the target date fund along with some little amount or maybe a larger amount of another different equity asset class.
Well, you actually have, with the 2 funds for life, a glide path and a formula for this. Can you tell us about that?
Well, there are several ways that it can be done. The book explains both. The most aggressive one is that you would basically take your years to retirement. In other words, when you have many years to retirement, you want to increase your exposure to small cap. And as you get closer and closer to retirement, you get less and less in small cap. In fact, the portfolio, by the time you get to retirement, is out of small cap in total. Now, that's one way it can be done. The other way it can be done is just simply to put 20% in small cap value forever, along with the target date fund. I mean, you can go both ways, and Chris Pedersen, the author, an engineer, and I think a great teacher who works with our foundation, wrote the book, and it takes people through the process step by step. And it is, again, it's free.
Well, one way you can actually, maintain some risk in the target date fund is to pick a date that's further out from your retirement date, right, Rick?
That's correct. Again, that's getting underneath the hood and saying, okay, forgetting about the date, what do I want as an asset allocation? And Paul is right. I mean, let's say with Vanguard target date funds, the index funds, you can only go up to 90% equity. And so they start 90% equity, I believe, starts at the 2045 fund. And it's the exact same asset allocation for the 2050, 2055, 2060, 2065, 2070. It's the same allocation. So if you want to maintain 90% equity in your target date fund, you could buy the 2070 fund and you're pretty much guaranteed to be 90% equity in that fund for the whole entire time that you're going to be working without having to make a change later on. Because if you don't change, if you buy a 2045 fund or a 2040 fund, every year you get less and less and less in equity. It takes money out of equity and puts more and more in bonds, which maybe isn't what you would want to do. So yes, you could look under the hood, go further out if you want to maintain that 90% equity. And why does it have 10%? A lot of investing is psychological, right? I mean, if you have 100% equity, it's really hard to be 100% equity 100% of the time. And just that little bit, 10% in bonds, even though it may not do anything to the portfolio, as Paul said, or even if it may reduce the return in the long term, which I'm questioning whether it's 0.5%, because after all, if the stock market goes down, you're going to be selling bonds in that fund and buying stock. So there is an asset allocation or a reallocation component where you actually pick up more return because of this rebalancing between stock and bond within even 90-10. So let's call it 0.25 instead of 0.5. The fact that you have bonds in the portfolio, to some people, that's important because it helps them stay the course. So again, a lot of investing is, first and foremost, you have to stay the course. Whatever strategy you come up with, you have to stay the course. If you don't stay the course, it's not going to work. You're going to get out at the wrong time. So that little 10% in bonds may help you do that. If it does, then it was worth giving up that 0.25%.
Yeah.
And one of the things that, if I just may insert this, whether it's 0.25% or 0.5%, what we teach, in fact, I've got a seniors graduating class I'll be speaking with in May. And one of the points I'll make to them is for every extra 0.5% you make on your investments over a lifetime, you are more than likely adding $1 to $2 million more to spend and more to leave. So even if it's only 0.25% of 1%, and so instead of $1 million to $2 million, it's 0.5 to $1 million. I mean, whatever it is, it's real money. And the cost or the reward comes with the education, as far as I'm concerned. And the more they understand this process, I think the better they're going to do. And so I think Rick is right. It's an emotional thing. But I think the whole idea is to figure out, how do we teach people to do the right thing from the day they start investing? And Rick and I would agree, we want no load funds. Never buy a load fund. Call me if you're about to buy a load fund and tell me which one you're about to buy. I'd be happy to help you sort through the funds and find a no load fund that does the same thing. There are a bunch of things that we both agree 100% on, and it's all about the probabilities of a greater success if you do those things.
Yeah. So why don't we, because I love both of you guys' perspective, and that's why we really wanted to have you guys on together, but small cap. So Bill, you ready to get into the small cap a little bit? Because that's really the meat of what we wanted to chat about with these guys.
What's interesting is when I started and woke up, I think I found Paul Merriman first. And I read a book of his, and I started out in the 10 funds for life domain, and I forward rebalanced into the down equity classes because I was a physician and I liked complexity. And I thought, just like you said, you're going to get those 0.5 extra percents. But as I went forward, I was like, I don't want to manage this way. And my wife is not going to be able to manage this way. So I started getting simpler. And then I probably oversimplified a little bit. And I was sort of, VT and treasuries and chill. That was kind of where I ended up. And then I started diversifying a little more because the rebalancing was within VT, which is a total world fund, which maybe, Rick, you would agree with that. I don't know.
Well, in a Roth account or a retirement account, VT works well. It's just simply the world equity fund. Now, why wouldn't it work in a taxable account? It has to do with taxes. If you invest in a mutual fund that invests in international stock, you have to have 50% or more of the fund has to be in international stock for you to get the foreign tax credit. And with VT, it's only 35% in foreign stock. So you lose the foreign tax credit if you have that fund in a taxable account. So in a taxable account, you would have 65% in VTI, which is the U.S. total stock market fund, and 35% in VXUS, which is the Vanguard Total International Fund. Therefore, on that VXUS, you would get the foreign tax credit. So that's a little nuance there, but it just has to do with taxes. But in general, you are correct.
All right, Paul, small cap value. And let's dive deeper into this because of your tables. We talked a little about the target date, 2 funds for life. One of our listeners and friends advocates a 50-50 in the growth phase between large cap and small cap value. But for me, small cap value has a long market cycle. I mean, it's, a 30, 40 year, to me, you correct me if I'm wrong, market cycle, especially lately. And to do this, just like you do with your 2 funds for life, it's really better to start when you're younger. And what would a late starter do?
Well, first of all, can we just talk about this performance problem with small cap value? People need to understand there's small cap value, and then there's small cap value, and then there's small cap value, and then there's small cap value. And there are more of those small cap values because there are at least 6 major ways they slice and dice, and they call them small cap value. And then people come out with funds that don't even fit any of those 6 small cap value designations in terms of an index. And yet they manage them in a way that is considered by the U.S. government, actually, a non-traditional index fund. They still consider it an index-like fund, but it's called non-traditional. And what do we know about these index funds? The difference in return over time is huge. If you looked at the 15-year return difference between the top and the bottom of those 6 major small cap value indexes, it's a 3% a year difference from the top to the bottom. Well, 3% a year is a big deal. If you compared 6 different S&P 500 funds, probably the only difference you would see would be the management fee. That would dictate whatever that difference might be. So when we talk about small cap value, we really need to understand what way are we looking or counting on the manager to manage the money. Now, what I do know, because people are saying small cap values just hasn't done well. Well, I can tell you over the last 5 years, I just pulled the numbers up this morning, small cap value at Avantis and DFA, that they are providers of small cap value. They both have done better than the total market index and the S&P 500 over the last 5 years. Okay, that's number one. If I go back to 2000, and one of them, a DFA fund, started in February 2000, I know that the return over the last 25 years is about twice that of the S&P 500. Twice. Now, there were periods, like you say, there are periods where the small cap value came down and touched basically the S&P 500, and then it took off again. Yes, there are long periods of underperformance, let's call it, and some great periods, shorter periods of outperformance. But the bottom line is there is no evidence that small cap value has failed, because what has failed are small cap value indexes that are not built to take advantage of all the premiums that are possible within the small cap value universe. So I think the performance is still there. And yes, there are historically 15 to 20 year periods, about 4 of them, where you got the same return at the end of the 15 to 20 years in small cap value versus the S&P 500. Now that, by the way, is not exactly true for somebody who's building a portfolio, because for every dollar that went into the small cap value index over the last 90 plus years, dollar cost averaging every year into it, you ended up with about $24 in small cap value to every one that you ended up with in the S&P 500. If you looked on a lump sum basis, it's about 12 to 1. So you're absolutely right. For the young investor, whoa, what an opportunity from everything we know about the past. So in my case at 81, I've only got about 25% of my equities in a small cap value. And that's as much exposure as I want. But I do have it, not because of me, because my wife and I have enough money to live on in the fixed income portion of our portfolio. The equity portion is for Western Washington University, our children, and those other people that we're working to leave money to. And we think we should take more risk for them than we do with our own money that we're living on.
Well, that's important, because that's generational wealth. And that's one of the things that Rick is going to be working on. But I'm really curious, Rick, do you have small cap value in your portfolio?
I have had small cap value for over 20 years. I used to be an advisor, and I went to the same DFA conference that he went to, and I studied this. And I'd like to say that what Paul said is right about value is in the eyes of the beholder. So at different times, different value factors do better than others. You might say, well, we're going to use PE ratio as our value factor, and we're going to buy low PE ratio stocks. Okay, there are periods of time where that is the best performing value factor out there. Then there's, I want to use return on equity, another value factor. Enterprise value, another value factor. price to book, another value factor. So there are many, many different ways of measuring value. Value is in the eyes of the beholder, okay? And so all the different fund companies do it all differently. All the different index providers do it all differently. So Paul is right. Some of them have done better than others. And you can go back and look. And over the last 5 years, I just looked, the way Advantis did it did slightly tiny outperform the market over the last 5-year period of time. Now, other value funds didn't. Not to say Advantis is going to be the one that's going to outperform over the next 5 years. We don't know. But unlike small cap, where you've got S&P, you've got CRSP, you've got MSCI, where they say this is large cap, this is mid cap, this is small cap. If you look at the performance of all of the large cap funds, and they're going to be highly, highly correlated. They might be off by 0.1%, just like Paul said. All the S&P 500 funds are all the same except for the fee. If you look at the mid-cap indices, it's all the same thing. We're just talking the mid-cap stocks. And small cap the same way. It's all very highly correlated because the cuts are fairly close amongst S&P, who is an index provider, and CRSP, and MFCI, and FTSE, whoever you're using as an index provider. But when you get to value, now it's all over the map. Everybody has their own version of what value is. And Jim O'Shaughnessy wrote a book called What Works on Wall Street, and he went back decade after decade after decade, and he said, what worked? What outperformed? And a lot of these things were broken down between different deciles of factors, like, high dividend yield outperformed this time, which can be considered a value factor. And then price to book outperformed this decade, and then low price to book outperformed that decade. So the problem with small cap value is, which value do you pick? We don't know. I mean, it's an active strategy. You don't know which one is going to outperform in the future. Now, you could say, well, we'll go with DFA. Well, they use price to book. Actually, it's the inverse of this, called book to market. Okay, that's what they use. Advantis uses a combination of various things. S&P uses something else. And you could do these backward-looking studies, and you could say, well, which one outperformed over the last 5 years? And say, well, the way that Advantis or DFA did it, price to book or book to market, that actually outperformed by a little bit over the last 5 years. That's great, but is that going to outperform over the next 5 years? I don't know. Who knows whether it will or not? So when you're looking at your value stock and your way of doing value, you really have to really dig into it and look under the hood and say, well, how do they do value? And how does this other one do value? And how do they do value? And what do I think value is? It's really not easy to come up with what the best way of doing value is, because all these different ways rotate around as far as, which one is outperforming the other one at any particular time. And so you got to kind of pick one, and you have to stay with it for the rest of your life. This is not a trade. This is not a trade. This is a philosophy of how you're going to invest your equity money. If you decide to take 20% of your equity money and put it into a small cap value fund like Advantis or DFA or many of the other ones that are out there, there's research affiliates, fundamental indexing strategy, whatever it is, however you're going to do it, it has to be a lifelong investment strategy that you're going to stick with. Because if you bail on this, you're going to bail at the wrong time. And now you have locked in. You have sunk cost, and you've just locked them in. And now you're going to underperform, guaranteed. So if you go down this path of putting small cap value in your portfolio, you have to, number one, understand it thoroughly, what you're getting into. Number two, know that you're going to be paying more money. The cost of these funds is higher than just buying a S&P 500 fund or a total stock market fund. It costs 0.03% to buy a total stock market fund. It might cost 0.3% to buy a small value index fund, but it is 10 times higher. So the cost will always be higher. And the last thing is, it may not work. You may not get a premium. Nobody's guaranteeing a premium. I mean, Gene Farmer just recently came out in an interview and said, look, when small cap value became popular because of my research and Ken Friend's research on small cap value, when we came out with that, people started piling into small cap value, particularly because of DFA's success, as Paul said in the 1990s. People started piling into small cap value because of excess return. Oh, we're going to make more money being in small cap value, so let's buy it. And people piled in, and all of these fund companies came out with small cap value indices and small cap value funds and fundamental indexing, and now there's ETFs, and there's all this small cap value out there. Even even Vanguard has 3 different small cap value funds that you can buy. People buy it not because you get a higher return for taking higher risk. They bought it because you get a higher return. You get a higher return. That's what the data says. Well, guess what? Because of that, and this is Gene Fama talking, not me, because everybody buying it or bought it because you get a higher return, now it's not working anymore. It distorted the market. Just like in physics. If you observe something, it changes the observation. It's really weird. Quantum physics is that way. It's really strange. You can't observe something and expect it to actually happen that way in the future. Once you observe it and you write about it, and all these fund companies pile on with all their products and they sell the outperformance of it, it's no longer going to be that way anymore. It changes the market. This is what happened to me. I've been investing in small cap value for a long time. I understand why I'm not outperforming. It's because everybody else knows. And we say something, there's a saying on Wall Street, once everybody knows something, it's not worth knowing anymore. And unfortunately, this is what's happened to small cap value. I don't know if it's going to change or not, but I'm kind of stuck in it. I've underperformed, and I know I got to stick it out. I'm 67. I got to stick it out for 20, 25 years, however long I live, to maybe it'll outperform. But I know I'm going to pay fees. And I know I'm not going to track the U.S. stock market. You really need to understand what you're doing here if you deviate from the total market approach. You really need to, because if you don't, you're not going to stick with it. You're going to bail at the wrong time, and you're going to hurt yourself.
So is it not also true that the S&P 500 from 1975 to 1999 compounded at 17.2%?
The S&P 500 did it? I'm fine.
Yeah, that's what it was. And so people, they found the magic. They knew what to do with their money. So money goes in. I remember being at some conference, a money conference of some sort, and people saying, why should we do anything but just put it in the S&P 500? And since 2000, the compound rate of return has been 7%.
Of the S&P 500?
Yes.
I'm not sure about that, but I could go and check.
So what does that mean? Does that say that we can't count on the S&P 500 making 10%? Yes, that does mean that we don't know.
Small cap value is such a tiny, 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 tiny portion of the U.S. stock market. It's a small microcosm of the U.S. stock market. And you're piling an awful lot of money into this small, tiny microcosm, saying this small, tiny microcosm outperforms by 4% per year. No, the data says that in the past, because of illiquidity, because of high trading costs, because nobody even knew this existed, it actually did in the past, based on Farmer French research, outperform by a significant amount. It hasn't done it since, because people found out trading costs shrunk, liquidity, all of a sudden now there's a lot of liquidity because all these funds out there, so the premium goes away, or at least you have this thing called factor decay. More people do it, the less it works. Okay, I'm not saying you don't do it. All I'm saying to people, and I've been saying this all along, if you decide to go down the road of doing small cap value in your portfolio, you better know what you're doing, because odds are you're going to bail on it, and you're going to bail on it at the wrong time, and your performance is going to be less than just buying the market. That's all I'm saying.
And the other side of that coin is the trap. And this is true of the market in general. It's true of technology stocks as well. The trap is people are actually more likely to buy when they're up. So after small cap value is at a 5 or 10 year run, there was a 10-year period. I think it was 2000 to 2009, that small cap value outperformed large cap blend in all but 1 year.
It did.
All but 1 year.
It did.
And so people then say, whoa, that's a good place to put money.
Right, exactly.
So if all we do is jump in at peaks, I don't care whether it's technology or the S&P 500 or small cap value, we are not likely to do well. And the question is, will there be a premium? The average 40-year return on small cap value going back to 1928 is 16% plus a year, looking backwards at the indexes that Fama and French created. That's the good news. What we talk about is the possibility of getting a 12% return, that in relationship to the 10 that people are likely to get historically from the S&P 500. That might be a pipe dream as well.
So it's a 2% risk premium in small cap value over the market, which, by the way, I mean, the equity risk premium today going forward is about 8%. It's 4% over Treasury. So you're talking about like an 8% expected return from equity. So you're talking about a 10% expected return from small cap value. And I don't know if that's true or not. I mean, again, I don't know. I mean, nobody knows whether the small microcosm of the market is going to outperform the rest of the market. But theoretically, it should, because there's theoretically more risk there. Those companies are not, you know, if you looked at them and say, ooh, why would I ever buy this company? I mean, they've got a lot of debt. It looks like it's going to go bankrupt next week. I mean, why would I want to buy it? And you probably wouldn't go out and buy one company, but if you bought 1,000 of these companies that all look the same way, or 700 or 800 of these companies, now you've mitigated away any of the individual risk of each one of these companies going under, because you're owning this big portfolio of these companies. And then you have to look at that portfolio and say, okay, well, what is the risk of this? But it is still higher risk than the market. It is no different than saying, I'm going to buy a junk bond fund versus buying an investment grade corporate bond fund, which have all the best companies in it, all that are AA rated, single A rated, investment grade corporate, high quality corporate versus junk bonds. You buy junk bonds, you're expected to make a higher rate of return because they're junk bonds. They're really junky companies. It's really the same way with small cap value. You're buying really junky small cap stocks. You're just packaging them together in a portfolio that the idea is, well, I'm going to buy a whole bunch of these junky stocks, and therefore the expected return on the junky stocks is going to be higher than the rest of the market. Same thing with small cap, with high yield bonds, junk bonds versus investment grade bonds. I mean, that's the theory behind what you're saying, Paul. So the other part of this, which we haven't talked about, is yes, you might get a higher return from small cap value, but there is definitely more risk there. You're taking more risk to do it, and you're paying more fees.
Can we talk about that risk?
Well, sure. I don't know how you can say there's not more risk, but go ahead.
This is great. This is what we wanted. This is the battle of small cap value. This is the Paul versus Rick thing. Now, Paul, you need your turn.
Well, I've got a table that we have tracked the return 1 year at a time of the S&P 500 as well as small cap value, and the portfolios that we recommend people could put together. What we know looking over the period since 2000 is that the small cap value, if you accumulate the losses of all the years they lost money, and you did the same thing with the S&P 500, the losses were actually higher on the S&P 500 than the accumulated losses on the small cap value. Now, that's not as long a period as we would like. If we take it back to 1928, it's not that pretty because you have this horrible thing that happened in the 30s. But if we look since 1970, where more people know about small cap value and know about the S&P 500, there is not that advantage in terms of risk. And remember that the higher standard deviation, which isn't all that much higher with small cap value, that standard deviation is measuring upside volatility just like it's measuring downside volatility. And most of that extra volatility is coming from the upside, not the downside. I just did this morning, looking back to 2000. We always argue, is 5 years enough? 10 years enough? Is 50 years enough information? I do know this, that at the end of 1999, the hot stock was Qualcomm, up over 2,500%. The second was VeriSign, up over 1,100% during 1999. So I could have taken all of the hot performers in 1999. And of course, it was a technology boom that was going on. So we understand why these people were where they were. If you put money into Microsoft, you would have, oh, and by the way, Qualcomm has grown to be worth about 284%. VeriSign is up since 2007.3%, not compounded 7.3, up 7.3, period. Microsoft is up almost 1,400% since that date in 2000. Dimensional's small cap value fund is up 1,288% during that period of time. From my view, when I look at where people have taken a lot of risk to get a higher return, by the way, for what it's worth, VOO for that same period of time is up 600%. So the small cap value doubled the return from 2000 through 2024, or right now in 25. All I'm saying is there's evidence that it can perform. And the reason I gravitate and we recommend the DFA Small Cap Value Fund or ETF, the Avantis ETF, because they're people that are all dedicated to looking at this in an automated academic way. And so I feel like when my now 2+ year-old granddaughter was born, we put half of her 401k money, this is money for later when she's older, in small cap value, Avantis, and half in a total market Avantis fund for large cap blend. And when she's 18 and she finds out about this, what I'm hoping is she will see years that small cap value did better, years that large cap blend did better, and that she won't touch it, that she will just convert it into her IRA, her Roth IRA, or her Roth 401k and let it go. But I do believe that if we put it all in small cap value, she'd see periods that were terrible and would want to quit. But by diversifying between S&P 500 kind of and small cap value, I think she's going to learn the right lesson. But you're right. You got to have the ability to stay the course.
And I probably made a mistake. I don't know if you were ever in small cap value, Jackie, but I was in it in the 10 funds for life, and I probably suffered from recency bias. And I, as a late starter, got out of it. I just didn't see the benefit for me because I wasn't willing to stay the course into my 80s and 90s. I needed a little more return. And I was like, well, this isn't working for me, and I want to retire. Jackie, what do you think about small cap value?
Well, I really love Paul, but but I think I'm more on the Rick side and kind of like you.
Sorry, Paul.
Sorry, Paul.
I think if you sent in some more tables, maybe we might resolve this.
To both of you guys' point, stay the course is probably my biggest takeaway. I remember, and I think a lot of late starters might feel this way. Bill would get this question every day in the Facebook group where they're like, okay, I'm ready to start investing. What do I do? And a lot of times they want to say, let me listen to this person. Let me listen to that person. Let me add that. They want to start with the complex, and they're likely not to stick with it because they're just figuring this out, right? And I know when I was a bit younger and I was trying to figure out what to do with my 401k, and I was just starting to teach financial literacy, Paul. So my heart was in the right place. So I came up with this silly acronym to try to teach people that this is to help you stay diversified or to help you be diversified. The acronym was SMILE. It obviously didn't take off, but it was small cap, mid cap, international, large cap, and emerging markets. And that was my way of trying to remember to spread it out.
Terrific.
Way too complicated. Way too complicated.
That's my point. That is my point. Now, it took me a few years to realize that it was way too complicated, right? And I definitely wouldn't have stuck with it. So I have since changed it, and it's a lot more like you, Rick, and Bill always outs me, but my go-to fund is I don't know how you guys are going to respond, but it's a large cap growth, and then I have a little bit of fixed income, typically not bonds. But anyway, that's what I stick with. That's what I feel comfortable with. But I was trying to overcomplicate it. And it was fun for me. I did enjoy putting together my own portfolio. So it wasn't a waste of time for me. There was a learning experience in there. But that was just my sort of journey from, okay, how do I not make this so Yeah, that was my journey. And there was a lot of lessons in there.
So what do you tell your daughter? I'm going to tell my kids one fund, 100% stocks for 10 years maybe. And then, you can look at something else. And if you get to $100,000, you can start diversifying like one of my friends.
I disagree with that. I really do. I believe that we should teach young people to invest like multimillionaires immediately, right out of the gate, so that they do the right thing, indexing, low fees, low taxes or no taxes. All those things should be part of what they do. And to the extent that we keep it very simple, I don't have anything wrong. I'm not arguing about simple. We have 44,000 people approximately who subscribe free to our newsletter. Most of them are engineers. Does that come as a surprise to anybody? They are people who love the evidence. They are people who understand long term. They understand how to design a plane, and they try to take every ounce they can off the plane so it minimizes the cost of fuel. All these things. That's part of their life. Most people are not going to like the work that we do if they don't like the idea of what I would consider meaningful evidence. We can never know the future, but we can see the past and learn from it.
All right, wait. We got to stop with this evidence thing. This is not science. This is not physics. Okay, the markets are not that way. So this whole idea that this is evidence-based investing with the marketing idea of, gee, if people think it's science, then they're going to invest with us and they're going to put money with us and we're going to make fees off that money. I mean, that's where the whole term evidence came from. Evidence-based investing came from a marketing person that used to work at Buckingham Asset Management. And they said, let's call it evidence-based because it sounds so scientific and people want absolute answers. And so let's start calling it that. It's not evidence. Sure, you can look backwards and say, well, there's evidence that small cap value outperformed because here's the data. It means nothing about going forward. This is not science. It's not physics, not mathematics. It's a probability. And how big is the probability that small cap value will outperform going forward just because it outperformed in the past? I don't know. Neither does Gene Farmer. He doesn't know either. Gene Farmer says you're not going to know whether small cap value outperformed or not over your lifetime until your life is over. And then you're going to know. But until that time, you're never going to know because there's no evidence that it's going to actually happen that way. So the evidence thing, evidence-based investing, is a marketing pitch, is what it is. It's not reality when it comes to investing. It's not science.
Are you calling me a salesperson?
I would never do that, Paul.
That's a dirty word.
To be fair, when we all of us make a decision about almost anything in life, we use less than scientific points of information. What we do have, and I think it's meaningful to me, I believe that the future will look like the past. As opposed to most people say, you can't depend on the future looking like the past. No, I think it will look just like the past with one exception. Last year, the market was up 25. Year before that, it was up about 25. You can go back and look at lots of years the market was up 25, in fact, over 30. In fact, losing 10 or more. You can look at all of these returns, and I have no idea what went on during each of those years, going back to 1928. All I know is something was going on that got investors to push small cap up and large cap down, or the other way around. We have quilt charts that I hope you will share with people, Bill and Jackie, because they let you go back to 1928 and look at each year and see how these different asset classes performed. And what is the most meaningful thing is it's a random event kind of a thing. They're all over the place. But there are some important lessons that tell us which ones should be the most productive, at least based on the past. You may not call that evidence. Now, by the way, the one thing I don't have I don't have anything to say about the sequence of returns. We can never know the sequence of returns. The fact that the market will be up 10% or 15%, that's an easy thing to say. But how they come in and how the sequence is through the rest of my life, if I've got 10 years, I'm going to feel great. And they got 7 stents in me right now, and they got me on a heart monitor trying to figure out what are they going to do next to keep me alive for 10 years. Well, I'm going to make it because I want to be here to debate you in 10 years, Rick.
Okay, I hope so, Paul.
But the fact is, that is evident.
Maybe you'll win one of those before then.
There is evidence. We can make of it what we wish, but our whole life is based on decisions are based on evidence. The evidence that most people had, and Bill, you said it, you got out because it wasn't doing what you wanted for it. So you took a piece of relatively short period of time and said, this is not right for me. That is the typical kind of evidence people use. We're trying to look at decades and decades of evidence in the hopes that people will make a good decision and stay the course.
I think both of you have great points. And Paul, what I've learned today is that there are different flavors of small cap value. And Rick talks about the cake and the icing on the cake. And small cap value is the icing or sprinkles on the cake. And I love that analogy.
The color of the sprinkles on the cake. It doesn't matter. It's like, whether you have small cap value, it doesn't matter. What matters is have a global equity portfolio, stay the course. That's what matters. This peripheral stuff, whether you should have small cap value or whether you should have this little thing in your portfolio or that little thing or 2% in Bitcoin or whatever it is de minimis. It doesn't matter. What matters is focus on the cake. Focus on the cake. The cake is your allocation between global equity, fixed income, and your cash component that you need for your living expenses and anything that might pop up. That is the cake. That's what people should focus on. These conversations that are out there in the noise in the media is not about the cake. It's about the icing, it's about the sprinkles, and it's really about the candles and the bright candles that are flashing like this that get blown out at the party and then it's over. Right? Focus on here. That's what we're trying to do.
You're talking my language here.
Well, and Paul has 81 candles on his birthday. He's got a lot of small cap value.
Yeah, now we know that Rick has got to get out of here, but Rick, that is a great way to sort of end the show. And we just love you guys because you have such deep knowledge. You're so smart. And it's just great to kind of have these conversations and to show that you don't have to agree on everything, especially when it comes to something as big as investing in your portfolio. So we see how people can actually peacefully have a conversation where they don't agree 100%. So for our audience, our challenge to you is, which do you prefer? Think about your own situation. Think about the mistakes Bill and I mentioned. Think about these two gentlemen and the masterful cases that they have made for their respective philosophies. So this has been so great. What do you think, Bill? I know it was your baby getting these two guys together, and it was fascinating to me.
Well, it turned into a bit of a smackdown here. It was emotional. I love it because a healthy debate is what this is about. And we may have gotten in the weeds for our audience a little bit, but we want to encourage you to look at this. Educate yourself if it's right for you. My opinion is if starting at 50 and wanting to retire at 63 or 65, it probably wasn't right for me. And it may not be right for late starters. I think it probably might be right for the 25, 30, 35-year-old that's willing to stay the course. And that's the lesson for me. What I've also learned is when growth fails, that's when your recovery asset classes bloom. That's when international blooms. That's when small cap blooms. And that's the seesaw, the teeter-totter of the quilts that you're talking about. So, this has been really beneficial for me. I love the debate. I love the knowledge you've brought to our audience. And I hope that this encourages people to investigate their own personal philosophy and needs. You need to use something like Portfolio Visualizer or Portfolio Charts to, test your portfolio. Are you meeting your ability to take risk and your need to take risk, right?
Well, and if I may recommend something that we do to try to help, we're all free all the time. So we have a thing called boot camp. And if you go through boot camp, you will be taken to 10 forks in the road that every investor is going to make. And we do a podcast, we do a video, and we do an article about each of these subjects. And our hope is it will give people the education that they need to make that decision, stocks versus bonds, to make the decision what funds, equity funds to be in, to make the decision how much in bonds, how much in stocks, to make the decision where you take money out on a variable basis or a fixed basis. Each one of these is dedicated to helping you as a do-it-yourselfer at least understand how we feel about the past, because that's what it is. It's all about the past. We have nothing else to hang our hat on.
And I do have a shout out to the Bogleheads conference here, because they have a Bogleheads 101 or Financial Education 101 series where for maybe our late starter audience, that would be an excellent way to get your feet wet and learn the basics of investing. Right, Rick?
Yeah, and it's on the website at boglecenter.net. We have all the videos. They're all there for free. You could go back and you could review Boglehead University 101, and then there's the Advanced Boglehead University 501. In fact, not last year, but the year before, Paul and I were both on stage debating the same thing. And I put up some pretty funny slides. And I think I won that debate, too, if I'm not mistaken. Right, Paul?
There you go. And we'll include that in the show notes. I forgot that for people that could not make the conference.
There are no winners and losers. There are just differences of opinion, right?
There you go.
And we take these, and I love the sort of the opposite ends of the opinion, because somewhere, the answer is always somewhere in the middle. To me, it's the hybrid solution, not being orthodox about it, right?
It's what's right for you. I mean, if it works for you, fine. As long as you're going to stay the course. If this is what you wish to do, fine. Just understand why you're doing it, implement it, maintain it for the rest of your life, and you'll be fine. If you don't understand it, then don't do it.
Yeah, I mean, the cake analogy is a great way to end this thing, because we all got to take a slice of Rick's cake, and we all may want some sprinkles and candles on it, or we just want, a plain cake, a pumpkin bread, or something else that doesn't have all the accoutrements. So, guys, Jackie, we want to thank our guests for what I think was a very healthy debate, and I think there was a 50-50 growth fund and small cap value outcome.
There you go.
Well, I don't agree with you, but
well, there was a 50-50 outcome.
The 50-50 outcome, okay.
Hey, we're the host. We got to be fair. We got to try to be fair.
We don't know what the 50-50 outcome is, but we know it's always a 50-50 outcome.
As long as you stay the course.
Stay the course. We agree with that.
Thank you you guys so much for joining us today and being open to share what you really think and not really care so much about the other, because our audience is the winner.
Oh, shocked. How could you say that? I just care about Paul. Of course I do.
We all care about him. But you guys are passionate.
Yeah, we are.
So it was just so good to be able to hear your different perspectives. Nobody's wrong or right. And you are so on it with look at your own individual situation. Stay the course. If you took away nothing else from this conversation, stay the course.
All right, guys. Thank you very much for joining us.
Thank you.
Thank you.
We'll see you next week on Catching Up to 5.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brazard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to FI. Cheers.